Don't cry because your employer only gives you or matches 10%. That's okay. When's the last time you got a free 10% rate of return on your money? Talk to me about sectors, folks. Don't talk to me about stocks, and don't talk to me about emotions. It's that simple. Don't place your children's names on your accounts. Don't put their names on your deed. Don't put your parents' names. Don't put your kids' names. Don't do it. Okay, we are going to be talking about money, specifically your money. In this life planning clinic, we are going to separate into 3 sections everything that you need to know: how to accumulate wealth, how to maximize your wealth and turn those pennies into dollars and dollars into thousands and thousands into millions, and we will protect it. And we're going to do all that in this 3-part life plan series. And we're going to have fun, too. I mean, it is fun talking about your money and figuring out how it is to make the millions and keep the millions and grow the millions. Before I get into each one of the segments and really get into the details of that, I want to make sure that we agree on a couple of truisms regarding wealth and regarding money. Number 1, I want you to know that money is not an accident. Those people that have money, that keep money, that build money, do not do that on accident. They do it through a plan. They do it through a strategy. And with that plan and with that strategy, they don't need to waste hours and hours and hours on the internet. They don't need to waste hours and hours and hours poring over financials and details. They need a couple hours a month. They need to look at it, they need to adjust, and they need to move on. So that's what we're going to do. We're going to, what's the old saying? Feed a man a fish, give a man a fish, feed him for a day, teach a man to fish, get rid of him on weekends. That's what we're going to do. No. We're going to feed and teach. The other truism that I want to make certain that we can all agree on is that we're going to stop guessing. You know, do you think you should buy this investment? Do you think you should sell it? Do you think, how much is it going to take to retire? How much is it going to take to stay retired? Can I spend my last dollar on my last day? Preferably have that check bounce. Whatever it is that you want to accomplish, I don't want you to guess. I want you to execute that plan and have a strategy. So let's stop guessing if we should have that right investment. Let's stop guessing. Let's just refer to the plan and make it happen that way. Trust your plan. Trust yourself. All these other talking heads out there, they're not you. They don't know you. They don't know your idiosyncrasies. They don't know what it is that you're trying to accomplish. You do. And if you have that plan, and you know exactly where you're at in that plan, then you don't need to guess. One of the biggest reasons why people fail to reach that financial success that they wish to reach is because of their emotions. Emotions have a big, big, big part as to how successful you are. Not just in monetary wealth, but when you broaden the whole, just being successful in life. Our emotions play a dramatic effect. I mean, how many of us feel our stomachs sinking and sinking and sinking and sinking as the market sinks and sinks and sinks and sinks, and then it's hoo-yah on an up day? Well, that's not a plan, and we know that, and we can't rely on that for the rest of our lives, for our kids, for our grandchildren, and everything else. So let's leave our emotions at the door. $100,000 question. Tell me what, for most people, is their longest, most successful investment. What is it? You all knew that. You're right. It's your home. Do you know that's like putting a dagger into my heart? Your home should not be your best investment. It should be a good investment. It should be a great investment. And it should average 6, 7, 8%. It's a great investment. But do you know why it's your best investment? It's your best investment because you don't think of it as your number one investment. You don't look it up in the price of the paper every day and say, oh my goodness, it went down 10 grand today. Oh my God, it's up 5%, 6% today. I'm going to sell it. No. Your home is first and foremost where you live, where you raise your family and your children. And that's why it's such a great investment, because you're not emotional about it. And when you're not emotional about your investments, you become better investors. And don't get me wrong. I am not one of those that believe that you should buy a stock, put it in a drawer, and look at it 30 years later. No, the economy is way too dynamic. There are far too many ways to make money in every economy. But if you follow the rules and you have your system, then you'll know when to buy or when to sell or when to accumulate. Then you'll have that strategy. To just say, I'm going to sell today because it's up, doesn't make sense. But if you say, oh, it represents 15% of my portfolio, therefore the strategy says I have to bring it back down to 10, even though it's high, it doesn't matter, I'm following the discipline. That's how people build wealth in every economy. So, when we talk about truisms, we have to talk about the economy and promise yourselves and me and everybody that you will not be a victim of the economy. As I talk to so many people and they tell me what's going on in their lives and what's happening and how much wealth they've lost and what's going on or how great they did on this deal or that deal or what they're doing now, they're usually talking about the economy and what's happened, and they're reacting to what happened as opposed to being proactive. That's called rear view mirror financial planning, and it doesn't work, and it's not very successful. We have to look towards tomorrow. We have to figure out what tomorrow's headline is going to be. Your plan will do that. But the key is to say, I will be an economic predator. I will be a predator in every stage of the economy, every time, no matter where we are. With that mindset and leaving your emotions at the door, you can achieve everything that it is that you want to achieve. It may be more wealth. It may be protecting your wealth. It may be a college education for a child or a grandchild. It doesn't matter. What matters is when you set it to writing and you stick to it, you will accomplish it. And as I stated, we are going to break down the Wealth Talk, the Life Plan Clinic, into 3 sections. Accumulation, maximization, preservation. Accumulation, a lot of people dwell on that. We're going to talk about it here in a minute. But we don't need to dwell on it. We're going to have positive cash flow every month. We're going to have money in our pocket every month. We're going to have extra money every single month. Savings rate is at the lowest rate in post-World War II era in the United States of America. I don't understand that. I know that there's a lot of opportunities to buy things, but we have to have positive cash flow every single month. Even if you don't need it, we need to set an example for other families, for your children, and for your children's children. We need to get back to being a saving economy and a saving generation. And we can. Positive cash flow every single month. You need to be able to look at your expenses and look at your budget and look at it and say, oh, yeah, this is my largest expense. I know that. Here's how I'm going to correct it. Anybody know what your largest expense is? Do you know offhand? Some of you, it's your mortgage. For most of us, our largest expense, taxes. The man. Income, capital gains, sin tax, ad valorem tax, there's death taxes, could be an estate tax, could be an inheritance tax. 60, 70, 80 cents of the dollar could easily go to taxes. And whenever the word taxes comes up, this is what the IRS wants you to do, and here's what we do. Our eyes gloss over, we get the 1,000-mile stare, and we don't ever even talk about it again. Whereas, or maybe you're pretty good with math, and you go on the computer and you do your tax returns, and it's perfect. And you did it exactly right. Or maybe you even gave it to a tax preparer to add up the columns. Good for you. That's not tax planning, though. That's not auditing your taxes. That's not saying, hey, you know, I have this really fun little thing that I do. It's antiquing, and sometimes we go away and we look at antiques, and sometimes we like to buy and sell antiques. Sometimes we go to the shows, sometimes we don't. Have a room set up for it, have ledgers set up for it. Yeah, and I like to buy and I like to sell. Maybe it's more of a hobby now, but it could be a business. Have you ever thought, well, gee, what I should be doing with that is turn it into an actual business, take the room deduction, make sure I take part of the electric bill, make sure that the mileage to and from is tracked so I get another deduction for that because there's not as many deductions anymore. But if you have a little bit of an audit of your life, there is so many different ways to put that money back into our pocket. But if you can't identify that your largest expense is your taxes, then how are we going to take that money, cut it in half, put that money back in our pocket, and then figure out how we're going to accumulate it? The plan. The plan. Sounds like a lot. It's a big, big, big bite. The way that we will be successful is by taking very, very, very small bites, digesting them, and then making sure that we've taken care of it, we moved on to the next segment. That's why I'm such a big believer in what I'm about to get to, which is the monthly meeting. When we talk about maximization, that's going to be where we need to spend the bulk of our time. Maximization is being smart investors. Not just where to invest, but how to invest. Because if you know how to invest, where to invest is easy. Most of us go right to the where, because that's really the sexy, fun part to talk about. We never go to the how. And I assure you, you don't need to be, matter of fact, I'd prefer it if you're not a board-certified accountant. Because I don't know where they get their numbers. I didn't realize that expenses could be revenue. It's very confusing for me. So we're going to keep it simple. We're going to make sure that with the knowledge that you have at your house, on your computer, at the library, you have every tool that you need to not only know where to invest, but to know how to invest with what you accumulate. We talk about investing, but we don't talk about the business cycle. Why is that? Why don't we talk about the business cycle? We should be talking about the business cycle. It's a part of our lives. That's going to help us maximize our money. Does anybody have a dream team in here? Do you have a dream team that you can say, this is what's going to get me to that goal? This is what's going to pay for my daughter's education. This is what's going to pay for her wedding. This is what's going to get me through retirement. I'm confident about my dream team. And so should you. And once you have your dream team, it should win your personal Olympics. So we are going to create a dream team. We're going to do it tonight. I have to say that many of us accumulate assets. We maximize them. We're good with a dollar. Frugal is a positive thing. But we don't preserve them properly. And that could be taxes, as I discussed. It could be other things. We live in a society that requires paper, documents. It amazes me that all you need to do is write something on a piece of paper, and it could be your get-out-of-jail-free card. It could save you hundreds of thousands of dollars on fees or probates or having your asset frozen just because you get sick. Let me use a situation that I usually don't use as an example, but this is very, very apropos. For many of us, 9/11 is a day that we'll never forget. It was a horrific event in our history. And there's many lessons to be learned from 9/11. Let me focus on the financial aspect for a minute. Do you know how many children actually lost their only caregiver, lost their only guardian, or both guardians, both caregivers? Do you have any idea how many that actually occurred to? Quite a few. Quite a few. Now think about it. How many of these children's parents, I'm sure are great parents, and as any lawyer would tell you, ignorance is no excuse, how many of these parents had a simple guardian form drawn up so that they knew who was going to be watching these children if, God forbid, something happened to them? How many? An amazingly small percentage. And you know what happens when you don't have a guardian? It's just like money. And for the right reasons, just the wrong effects happen. People fight. And sometimes children go places that you don't want them to go to, or they go cross-country, or they go to a brother or a sister or a parent that wasn't your wishes. Well, this can't happen. We have a responsibility. And yes, we're great parents. But a simple guardian form, something you could probably download on the net, something you can stick in your will, how could we not have that? You have children, you have grandchildren, that's your first homework assignment. You can't operate another day and function properly until you have a guardian form for our children. It's that simple. There's no gray in this. That's preservation. That's what makes us successful in life. Many of us have IRAs. Many of us have 401ks. cash accounts. You know what I'm talking about. Now think about this. I don't want to know a show of hands, but how many of you are certain what happens to that money when you get sick, when you die? Do you know who your beneficiaries are? I'd be willing to bet that who you think are your beneficiaries are not. So let me just give you a little bit. We're going to get to this in preservation in great detail. But let me give you a homework assignment. I want you to call up every place that you have a 401k, IRA, cash account. And I want you to ask them to send you your written beneficiary designations. Just get that thing in writing, and I'm sure you'll look at it and it'll be perfect and put it in your pocket. It won't be. You're going to find in many cases there are no beneficiaries written. You may have told somebody or instructed somebody to do it and it was never done. I was actually just meeting with somebody, had to go through an entire probate process. They had created a document to avoid probate. Probate is a situation that many of us want to avoid. It's time-consuming and costly and open to the public. So what happened was they had put all their assets into this trust that they created, and they forgot one of the IRAs. And there was no beneficiaries listed, and it was just the estate of. And it was probated, just because of that one asset. How clear are you on who your beneficiaries are? So when you do this homework assignment, do yourself a favor and look for 2 beneficiary designations. You need a first and you need a second, just in case of a simultaneous death. You'll be surprised how many people have on there people that are no longer with us, people that they've divorced, people that they don't want in their lives anymore. You just forget. And all of these assets are direct assets, meaning that they shouldn't ever get into the public's eye. These are direct. You shouldn't have to pay for a trust to create them. But think about this for when we get to preservation, because this is very, very, very important. Think about this. I'll give you my scenario. What if I have an IRA, happily married, everything's great. I die, not so great anymore. My wife is the beneficiary of my IRA. She inherits the IRA. Okay? And obviously we have children, and we want the children to inherit it. But she just, as most of us that are overwhelmed in a situation like that, doesn't do anything after inheriting the IRA. We're going to talk about taxes and all this, what I'm explaining in a minute, but just, I'll leave you with this. What happens when I die, she inherits it, she gets remarried, can't imagine why, and then she dies. I ask you, is there a chance that my children could be disinherited? Nod your head. How many of us are protected from that? Let's talk about accumulating assets. It's actually very, very easy. All I need you to do is spend time, not money. Just spend time. I went with my daughter and her friend the other day, and we spent the afternoon together. True story. Went to one of the big warehouse stores, went to the movies, went to lunch. You know how much I spent? $150. And it killed me. And it's still, as you can see, killing me. I'm thinking, wow, if I do that twice a month just to spend the afternoon with my daughter, it's $300. By the time she goes to school, I could have had 2 years paid for. Spend time. We now go to the park and we make a picnic, and we're very, very happy. And her college fund is doing just fine, thank you. We can get rich off of our employers. No more of this nanosecond, I'm going to look at the funds and I'm going to figure it out, and then all of a sudden I'm going to have my retirement in 20 years. No. What you need to do is look at it once a month in your plan. You're going to go through a checklist. This mutual fund doesn't fit the criteria anymore. This manager's been replaced. You don't need to read the prospectus in terms of trying to understand every little detail. You need to read it, pick out some very important information. Pow, boom, plan's done. You know you have your 401k maximized. Don't cry because your employer only gives you or matches 10%. That's okay. When's the last time you got a free 10% rate of return on your money? You take whatever you can get, but you maximize all of your employer plans. Rule 2, we have to have positive cash flow every month, no matter what it takes. We don't need $7 lunches. We don't need to go to the coffee shop 3 or 4 times a day or the cooler. We don't need all of that. What we need is to have positive cash flow every month. I keep a budget statement. And yes, I am normal. And I go through this every month with my family. It's awesome. It's great. When we're over budget, we stay home and have potatoes, very symbolic for dinner. And when we're under budget, we go out for dinner. Kids' choice if they come in under budget. And I have young children. They're in charge of the electric bill. They're in charge of the garbage. You'd be surprised how many people in my house are yelled at for keeping a light on. Electric's expensive. You just have to have positive cash flow every month. You keep this, you have a family meeting, you have a standard meeting, you go through it, you know you're fixed, you know your variable expenses, and you say, okay, we're under budget, we're doing great. Here's the vacation fund. Uh-oh, I'm over budget, here's what I'm going to do. And you're going to cut out the premiums. You're going to cut out all the extra cable channels you don't need. You will have positive cash flow every single month. Then you build your board of directors, the way most CEOs should have built their boards of Fortune 500 companies. And you say, if you're going to be my accountant, if you're going to be my financial advisor, if you're going to be my attorney, you have to submit to 2 board meetings a year. And none of this hourly fee stuff. Give them the statements beforehand, and you're going to be surprised how much wealth comes out of that meeting. The attorney's going to say, why is this in your name? And why isn't this in a 529 plan for the kid? And all of a sudden, there's going to be a camaraderie, there's going to be a discussion, and you will create wealth. Build your board. It's very important to do that. I talk about building wealth, and I want you to remember, it only takes $5. Give me your lunch money. $5. $5 a day is $25 a week. That's $100 a month. What if you would have done that when Microsoft went public? What if you would have done that with Home Depot, even at depressed prices? What if you would have done that during the height of the Vietnam War when Berkshire Hathaway was just getting started, Warren Buffett's company? What if you would have done that during Pearl Harbor, Iran-Contra, Bay of Pigs, name it, 100% of the time? You'd be a pretty wealthy individual today. And again, I am not a believer in buying and holding forever, but when we talk about building your dream team, you got to give me $5 every day. Direct stock plans, mutual funds, right into your favorite company. We'll talk about that more in a minute, but $5 a day. Do it for yourself. For grandkids, what a great opportunity to do it in college savings plans. One of the gifts from the tax code, Section 529, college education IRAs. They're awesome. They're letting us grow this money tax-free, so long as it's used for their qualified purposes. It only takes $5. Positive cash flow every month. Accumulate the assets. It's not hard to do. And now we maximize. We learn how to be a smarter investor by not only where to invest, but how to invest. Those are the steps that so are often overlooked. That's what we're going to study right now in the Life Plan Clinic. The purpose is for you to build some cheat sheets, some checklists, so that when you do see an opportunity or a potential opportunity, or someone says, this looks good, you look at your plan, you look at your checklist, boom, 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 pow, it's in or it's out. You go over on your monthly budget meeting, you figure out where you're at, you're over or under in a certain category, boom, it's done. You don't think about it. You're a predator in this economy. You're going to make money in every phase of the economic cycle. Question on your mutual fund, something comes in the mail, you don't understand, you go back to your checklist, boom, 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 you're done. It's that easy. That's what is when we talk about life planning. Here's what I want to start with. I want you to understand the flow of being a successful investor. This is it. Just follow this, put it on your wall, tape it to your computer. You have to create your personal wealth plan. I give myself a test. It's very easy to do. You can give yourself a test, ask yourself some basic questions, and then work through the problem. What is the return that you need? You know, the basics of planning. What's the cash flow that you're going to need? What's the inflation adjusted, what we call a real return you're going to expect based on what you're investing for? And then you just stick to your plan. I mean, if all of a sudden you need 40% in equities and it does great and you're at 60%, doesn't matter where the markets are, you cut it back down to 40%. And you do that on a monthly basis. Not every day. You don't watch it every day. You do it on a monthly basis. Based on the economy, you overweight the sectors. This is the key. You know the sectors, you're done. Create a dream team, stick to your discipline, follow a system. This is my system. I call it SEC. Everybody's going to have their own system. And like I said, I don't want you to be an MBA finance major. They think too much. I don't want you to be an accountant. I want you to look at this as you and I do, as consumers and as erudite individuals. We will tear apart the financials, but simply so we can say this number adds up, and we know what an expense is, and we know what a sale is. I like to look at SEC, sales, earnings, and cash flow. It's easy to do. Exercise your mind and attitude, because we do get emotional, even though we're not supposed to, about our money. It's something that's very easy to get emotional about. If you do, go take a walk. Take a breather. And I'm serious about that. People say money can't buy love. I love money, so I'm a little bit better off than the average person. But exercise your mind and attitude. That's it. It's the business cycle. That's what you need. The business cycle. If you can determine where we are in the business cycle, and where you think we're going, all you have to do is invest in the proper sectors. More valuable than any art at Christie's or Sotheby's, more valuable than anything else in your investment arsenal at this point is this graph. Cherish this graph. Relish this graph. You know what it is? Say it. No. It's the economic cycle. It's the economic cycle. It doesn't matter if you haven't had a day of econ in your life. It doesn't matter if you're Friedman or Keynes. It doesn't matter. What matters is there is a business cycle. Throughout my life, throughout your life, through biblical times, and probably for many, many, many years into the future, there will be a business cycle. And there will always be 4 phases, as far as I'm concerned. There's an expansion. It's the longest phase. It's the phase we like the best. Then there's a peak, there's a contraction, and then there's a trough until we go back to expansion. That's it. You've cracked the code. Now you can be using this as a successful, smart investor. And I'll tell you why. This is the economic cycle. Is it the stock market? No. It is not the stock market. That's where those million-dollar analysts and their high towers get it wrong. And we'll get it right. Each phase is almost textbook. It's very characteristic. I keep a cheat sheet. It tells me what happens in each phase. As soon as I get 80%, I'm pretty darn close to where I think I need to be. Could be off by a couple months, 6 months, but I keep a cheat sheet. Where would you say we are if I said, you know what, interest rates have been going up 3 or 4 different times. There's talk about raising the minimum wage, signs of inflation here and there. Stocks have been doing well. Lots of employment, very low unemployment. Where would you say we are? Would you say we're expansion, peak, contraction, or trough? How many say expansion? How many say peak? How many say contraction? Nobody. How many say trough? Nobody. That means, based on the laws of probability, it's probably going to be either an expansion or late expansion towards a peak. You realize that it's that textbook. It really is. You were not emotional about that decision. And that's exactly where we were in late 1999, in a late expansion close to the peak. Now, this red line represents the stock market. Look at it. It looks very much like the business cycle. It leads the business cycle religiously by about 6 months. As I was saying, it's almost a self-fulfilling prophecy. Does anybody know the day the stock market reached its highest point, the NASDAQ stock market? Anybody know the day? March 10th, 2000. I remember. It was my birthday. It was a great day. And it's fallen and fallen and fallen and fallen. Well, now think about this. What did the economy do in April, in May, in June, July, August? It went up. GDP kept going up. The stock market falls before the peak in the economic cycle. Now, here's a question for smart investors. They ask, well, what happens when stocks go down during an economic contraction? I studied that. I looked at it. And I looked at sectors. Don't talk to me about individual stocks. It doesn't matter. Talk to me about sectors. You know, I found a sector that did well every single time the economy contracted. You know what that sector was? Any idea? Tell me. Who said utility? Absolutely. That's a $100,000 question. Catch. Because he would have made $100,000. You go back and look at utilities during the bear market, during the ugly years. They were rocking and rolling. And you know, that wasn't a fluke. Go back and look at every contraction. Food stocks also, I heard. They do well too. Talk to me about sectors, folks. Don't talk to me about stocks, and don't talk to me about emotions. It's that simple. And during every single phase, there have been sectors that have outperformed and sectors that have underperformed. We're going to talk about those sectors. But again, you told me that we're close when I gave you the last scenario to an expansion or a peak. All of you said expansion or peak, which means that we're pretty close to the contraction. Now, how lonely is it when a market's up 80% in 1999 to say, you know, I'm going to take some off the table. I'm going to buy some bonds because I can only get 8%, but, you know, maybe I should do that. How many would be happy with that 8%? How many would have been happy if the utility index would have given you 4% as a dividend yield and grew 10 or 15%? How many of you? Very happy. But it's very, very hard because of our psyche, because of our emotions. Leave that at the door. You told me very, very well that we were close to an expansion or a peak. So if I told you that unemployment gapped down and it looks like it's kind of raking, and if I told you that interest rates had gone down, 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 looked like it's kind of raking. If I told you, though, something interesting is happening, there's not as much inventory, and productivity of the United States workers actually improved. Makes sense. There's not as much overtime given, so we do better with the hours that we utilize. Capacity utilization's up. We're better with what we use in the factory. Where would you say we are then? Think about it unemotionally. Think about it with your textbook, and then you'll find where we are. The business cycle is awesome. The business cycle is everything. Think about this. Almost every time before the economic cycle turned, the bear market was over. Done. Monetary policy's low, inflation's low, earnings disappointments have come down, 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 and they've started to tick back up. Consumer confidence is stabilized. It's not great. There's no clear indication, just kind of nowhere. Valuations, as the stock market as a whole, is improved. That's usually when the bear market ends. Now, most investors don't trust their plan. And they say, well, we'll wait until the stock market turns around or the economy turns around. The stock market's already probably halfway through its next bull market. Follow the economic cycle, not the stock market. Okay, and just to show you that volatility is part of investing, 5% or more declines is very common in the Dow Jones Industrial Average. It happens on average 3.5 times a year. But even 20% happens 1 out of every 3 years. It's part of investing. Are you a predator or are you a victim of the economy and of the market? We're going to talk about moving those sectors around with each phase of the business cycle. There are certain times, though, you don't want to just be looking every month and saying, okay, I believe that we're in an expansion, therefore I'm going to go into consumer discretionary stocks. Doesn't matter. You should have a dream team. I'd prefer that you build your dream team through things like the extra $5. You build a dream team. My dream team consists of 10 companies, 10 of my favorite companies, companies that I can describe on the back of a 3x5 card. I understand what they do. So obviously it would exclude companies like Enron, which I still don't understand what the company did or what they said they did. Companies that you understand that you can say, we are going to need this product or service 3, 5, 10 years down the road. I have another rule of the 10. Each one is a different sector of the market. And when I say market, I mean the S&P 500. They're a different sector. You and I are not smart enough to outguess the market as a whole. Now, my dream team, in the first couple quarters of 2002, what were the best sectors? Sectors you and I would have never guessed. Gold in a recession. Real estate in a recession. We didn't know that. That's why you have to have a little bit in every sector. And if one sector does incredible, my rule is if it's over 10% of the portfolio, cut it back down. Cut it back down to 7, let it get back to 10, cut it back down again. That's the only time I sell unless there is something tremendously wrong, something incredibly destructive with the company. Something dramatic, like a WorldCom. That's when you sell. If not, you keep putting the $5 in there. It's the cockroach theory. When you see one cockroach, there's 100 more that you can't see. Think about that with your stock. My system is SEC. It's easy for me to remember. Sales, earnings, cash flow. I believe, again, I can't spot and sniff out a criminal, and I'm not auditing their books. But I can go online, or I can look up a research report, and I can see trends in sales. I can see ascending sales. It's harder to monkey with sales. It's the top line. And I can look at earnings. However you want to calculate it, I can look at earnings. Whether it's before depreciation, whether it's after depreciation, I can see earnings. And I want to see an ascending earnings. And cash flow is probably going to be the most important of all these criteria. People like to talk about price to earnings ratios. You're going to find price to cash flow is going to be much, much more important. Cash flow is truly what's left. When you pay your expenses, what's left? Cash flow. And if you have a lot of cash flow, you can buy other companies. Or someone wants to buy you for your cash flow. Cash flow is very important. You're going to see it more. You're going to see more price to cash flow. Make sure you have these 3 ascending in your stocks. Build your dream team. These are the sectors that I spoke of. There's 10 in the S&P 500. When I talk about over or underweighting, you're taking more or less risk. So if, in fact, energy, which is usually depressed in a depression or a recession, because we don't use as much gas and oil, traditionally does very well. It's, by the way, the least amount in energy actually happens to be one that does well in early expansion. So does financial services. And they do the poorest at the end, because nobody's ever going to use financial services again. It doesn't matter that the baby boomers are going to be alive for the next 30, 40, 50 years, represent a huge percentage of our population. We just aren't going to use financial services anymore. Well, those two are actually the best performers when you come out of an early economic trough into an expansion. Watch these sectors based on where they represent in the S&P 500 and over or underweight based on those sectors. So utilities and food, they've done very, very well for us. You got to be a hero. You got to pare those down. That is predatory investing. And that works. And it makes sense. Then you have to look at macro trends. I love macro trends. Macro trends are a couple different things. Macro trends is when I open up the paper in California and it said that English as a spoken language is now a minority. That's pretty powerful. I can't process if it's good or bad. I just want to know how to profit by it. Where am I going to invest my money? Now think about this. I don't care what's going on a day-to-day basis when I'm talking about macroeconomic trends. Macroeconomic trends I just want to gobble up. Look at this as an economic macro trend. See this blue line? That's prescription drug usage. And obviously, the older the population, the more the usage. And even though it's a fast-growing age group, 70, 75 plus, it still represents a fairly small percentage of the population. Yet it's the most drug use. See this monolith, these two lines? That's the baby boomers. They like drugs. They went through the 60s. They're getting older. They're going to want a drug for everything. And they already do. I mean, think about the kind of drugs that are out there. You tell me that every single time healthcare falls off the wagon, so to speak, that's not something to add to in your dream team? There's 3 ways to play it. Either you're smart enough to buy the right drug stocks. It's hard to do. You can buy a drug mutual fund. We'll talk about that. Or, why not, a sector play that's not managed. You can buy a healthcare sector stock. A popular one that maybe you've heard of is a SPDR. You can buy it just like a stock. Buy it and sell it. A SPDR is just an S&P depository receipt, and you can pick a healthcare sector. Why not? If you can't pick the stock, pick the sector. If I were the czar of mutual fund investing, we'd have a lot of changes. Because mutual fund investing is the popular choice for investors. More people invest in mutual funds than almost any other investment class. You do it through your 401ks, you do it through your IRAs, you do it through just about everything. But why is it that most take a growth mutual fund, don't usually do as well as the market, say the S&P 500, they charge you more to do it, many of them are tax offenders, they tax you up the kazoo, and they have more risk? Follow your checklist when you buy a mutual fund and go over it every month. How long has the manager been there? I don't care if you have a 10-year track record in front of you that says this is the best fund in the world. If that manager, and the prospectus has to tell you this, is brand new, only been managing for a year, do you want to gamble on that? Think about it. Maybe you do, but I want you to make an educated decision. This is your money. No more nanosecond, this fund looks good, I'm going to buy it off of the ad in the paper. I always love the mutual fund ads. Someone calls me up and says, hey, can you buy this mutual fund? It's yielded 8% last year. And you're thinking, how did they get 8%? A bond mutual fund. Well, they did well as interest rates went down. Are they going to do as well next year? And then I read the prospectus, and I find that they don't even buy bonds anymore. They buy treasury derivatives and trade them, and they call it a bond fund. Do you know if your bond mutual fund, there's a lot of government bond funds out there that don't even buy government bonds. The largest bond fund that I know of, government bond fund, the last I looked had no government bonds. They had Ginnie Mae's. It might be good, but shouldn't you know? I mean, this is our money. Fund expenses. I care about the expenses. I want to know how much I'm paying. And I'll pay a lot if it's the best fund. And if it's not, prospectus revisions. That's when you find out if they're trading options with your money to try and tweak out a 0.5% or a 1% or something of that nature. When you look at performance, don't look at the advertisement. They can tell you a 1, 3, 5, 10 years since inception average. I want to know how they do every year. I want to know how they did last year and the year before. 1987, that's important to me. 90 is important. 94 is important. How'd they do in those years? Know the risk. The risk is critical. If I said that my mutual fund made 15%, you might say that's great. But if you took a risk of down 50%, you wouldn't. There's a popular fund out there that's advertising. It kills me every single time I hear this ad. It says something to the effect of, since the market low of 19 such and such, this is the best performing fund. Well, I looked at the fund since the market low of that year, and it was down over like 50%. Well, I mean, just to get my money back, they've got to make 50%. It better be a top performing fund. So look at the return every year. Now that you know sector rotation, and now you know what we're talking about in terms of sectors in a dream team, always ask for the top 10 holdings. Do you agree? Are they well diversified, or is it copycatting the same other mutual fund managers? Do they have any precious metals in there? Do they have any real estate? Are they looking in the future, or are they rear view mirror investing? That's very, very important when you're looking at your mutual fund. Do your mutual fund checklist. Investing is not complicated. Investing's simple. We make it complicated. We get worried about external things. We get worried about all the issues that have absolutely nothing to do with investing. You stick to your discipline. You make sure that you're diversified in all the sectors. You over or underweight based on where you think the economy is going, not where it's been. That's successful investing. It's not 2 or 3 hours a day looking at information that's probably not correct on the internet. It's doing it once a month and adjusting based on what's available. It's looking in your plan and saying, I'm over based on the test that I took. I'm cutting it back. That is successful investing. And it's something, because so many people like to talk about it, we get wrapped up in it. Don't. We're going to talk about, once you make it, protecting it and preserving it. So when you're overwhelmed with emotions, either on the upside or the downside, when you're feeling like you're the only one and you're running upstream, good. That's what should happen to the successful investor. A very, very, very smart investor said, you buy when the cannons are roaring and blood's in the streets. Someone else told me something that I thought was very important too. Saw that I was having a stressful day, and actually I found out later he borrowed the words from Alfred Sousa. He said you need to work like you don't need the money. You need to love like you've never been hurt. You need to dance like nobody's watching. Thank you. It feels good. It feels good. We're accumulating assets. We have a plan. We're structured. We're smart investors. We understand the most precious commodity that you could ever understand, and that's the business cycle. We're smarter investors, and we're smarter for it. And now that we have all that, we have something to protect. We all have assets, some more than others, but when you look at it, you have an asset. It could be a bank account. It could be a home. It could be a car. We have assets to protect. And as I had said before, we live in a litigious society. We live in a society that requires documents. We live in a society that wants to take it from us. Believe me, you can challenge me on a lot of things, but you can't challenge me on my love for my country. I am as patriotic as anybody. But I do not want to pay one more dime in taxes than I have to. And I will possess the right documents to do it. What I do with it is my business. And I will not spend more money to have things go the way I don't want them to go. Audit your life so that you can save on taxes. It's more than just a form. It's more than just a computer program. And the way that you can save on taxes is simple. How many of you have a side business? How many of you sell vitamins? Start a little business. Find out all the deductions you can get from that. Find out what the rules are. Can you deduct part of your home? Can you deduct your mileage? Charitable investing is incredible too. Charitable gifting. Are you helping and volunteering through charitable work? Are you deducting the mileage? They're not going to give you any money back. You better do it now. The IRA is incredible. So many of us don't realize that we still can contribute to an IRA. And the number went up. It's now more than $166 a month. That's my lunch money. We actually have extra money now to do an IRA. Find out what the rules are. Find out what your earned income has to be, what your other employment rules are. And with the IRA, you can do so many different things. And by the way, when it comes to IRA investing, let me share with you just a simple antidote for a life planning problem. So you have a 401k, you have an IRA, you have all of these what we call qualified monies, tax-deferred accounts. And then you have non-tax deferred accounts. Most of us put our normal accounts, our CDs and things like that, outside of our IRA, even if we don't need the income. We get a 1099 every year, it's a little tax bill, we have to put it on our income tax form, and we pay taxes. I don't get it. The IRA, now I've heard, and I'm sure it's not true for anybody watching and in the room, but I've heard that some people actually lost some money in their IRAs over the last couple of years. Somehow it went down, I don't know, markets. You didn't get to take a tax deduction, did you? That's a bummer. If you would have had it outside your IRA, you would have at least received a tax deduction, and if you would have just held that growth investment, you wouldn't have had any taxes, and when you did sell it, it'd at least be a capital gain tax as opposed to an income tax. So why isn't our IRA in our safe investments and our non-IRA stuff the more aggressive investments? Why did we reverse that? I never understood it. There's a new rule on IRA withdrawals. It's one of the coolest things that come out of the tax code. How many of us will take advantage of this? You realize that the money coming out of your 401k and IRA and whatnot is fully taxable. It's income tax, highest tax we have, other than death taxes. It's a big tax. So now you can calculate and figure out, based on a child's life expectancy, that the money can come out based on the child's life expectancy. If the money is invested properly, it'll probably grow at a faster rate than your child's mortality table suggests, and it'll probably grow for another generation, creating a dynasty. Yet, I can tell you what's going to happen. Something's going to happen. Your kids are going to call up, or whoever your beneficiary is, so-and-so is deceased, send me the proceeds. Someone's going to tell them later on, you could have done this. They try and do it, can't reverse it. 1099's already been issued. Sorry, out of luck, do not pass go, do not collect $200, you go right to IRS jail. Could have avoided that. Even think about, this is your next homework assignment. Call your custodian and ask them how to make that payout over your child's life expectancy irrevocably. Really give them something to look forward to. Why not? Think about it. College savings plans, free money, Roth IRAs. Senator Bill Roth came up with this incredible plan used by this percentage of those of us that have 401ks and IRAs. You have some money in a 401k or an IRA, and you say, wait a minute. The account value is down right now. I can pull the lowered valued account now, pay some taxes on it now, and then go ahead and put it in a Roth IRA that's tax-free. Never have to pull the money out. When I do, it's tax-free. Don't have to pull it at 7.5. Die tax-free. Don't have to do the whole thing. Do a little this year, a little next year. Coolest thing in the world. And I know the argument. Some of you say, well, I don't even buy green bananas anymore. I don't want to wait for this. All you need to do is a Roth IRA calculation. What's your tax bracket now? What do you think it'll be? Look at the next couple of years. What's your income now? Boom, boom, boom. You'll find that if you think you're going to be with us for the next 6 or 7 years, you better look into a Roth IRA if you want to put some more shekels in your pocket. Tax-free interest. You know, money markets don't pay very good interest these days. Almost the same rate as a tax-free. Look at it and make sure that you know the right one for you. Interest rates are low. It's amazing that in many cases, the money market rates and the bond fund rates, the tax-free pays more than the taxable after you figure out what your tax bracket is. Do the calculation. It's a simple calculation. I always say do the numbers. Numbers don't lie. Just do the numbers. Once you get your taxes down, now we can talk about all of the other essential documents. Documents are necessary, and they can free you up. Think about all of the things that you want to accomplish in preservation. Think about some of the things that you'd want to accomplish. We talked a little bit about income taxes, reducing that. What about control? Don't you want to keep control of your assets if you get sick or worse? Don't you want to make sure that the right beneficiaries, the right people, we talked about guardians. We want to make sure that the right people are raising our children and our grandchildren. Control is so important. Costs. We want to keep costs down. You don't want to pay everything out, whether it's to the public court system and the probate courts, whether it's to advisors, accountants, attorneys, IRS. We want to keep more in the family. With or without the right documents, you can accomplish all that. So what we come up with is the proper forms. First thing that you probably did when you got married financially is you opened up a bank account, bought a home. How much time did you give to how you own and how you titled that asset? 5 minutes? I don't know. Everybody else did it as joint tenancy, so that's how I did it. It's okay. But as, like I said, any good attorney would tell you, ignorance is no excuse. So my wife and I own our home. We own it as joint tenants. I get sick. I'm incapacitated. I'm nowhere to be found. Rates are low. Can we continue refinancing? Can she sign forms on my behalf in a joint tenant with right of survivorship home? Yet 99% of married couples own their homes as joint tenants. That's loss of control. Well, that's out. We don't want that. What about my IRA? Go and look and see whose name's on your IRA, your 401k. I assure you, I promise you, there's only one. It is an individual retirement account. It's yours, the account holder. And if your spouse calls up and asks to liquidate that account, they're going to be told no. If they are, and they do it for that spouse, it's illegal without the holder's written and expressed authorization. Do you have that authorization for your spouse, for your loved one? Why not? How could you go throughout a life without this get-out-of-jail-free card? It's called a durable power of attorney. It's a basic document. Write in there what you want. If you're going to write something, write a bestseller. Make sure that it has the provisions that you want. This is the essential documents. Let's talk about that titling question again. My wife and I, we own the home. You can still have it joint tenant and have that get-out-of-jail-free card. You can have something like a power of attorney. It's a basic document. Don't go and spend thousands of dollars on this. It's a basic document. But I have a tax problem. Let's assume you bought a stock. You've held it for years and years and years. It's in both of your names. You've done real well with it. One spouse dies. You made an agreement. If one spouse dies, You promised that you were going to sell this stock. The other person was going to take a friend and go on a cruise around the world. In my wife's case, it'll be her best girlfriend, I assure you. When she sells that mutual fund or that stock that we owned, does she have to pay any taxes? I'm dead. What kind? No, I don't even know what the size of the estate is. She has to pay capital gains taxes. I can assure you it grew. I told you it grew. She didn't die. I died. I don't have to pay capital gains taxes. She does on her appreciation. Well, that's silly. All you have to do is title it properly. You don't have to worry about that. It's pretty basic. Let's talk about the joint tenancy question again, because this really gets under my skin, especially when I'm talking about my own mortality, my own death. I used this example before, and it applies to my house. I own a house with my wife, 50-50 joint tenants. We both put in the same amount of money. I die, she inherits it. It's right of survivorship, as it should be. That's exactly what I want to happen. She gets remarried, doesn't change it. Guy lives with her for 5, 7, 10 years. And then she dies. Any chance he can get the part of the house and disinherit my kids? Yeah. What if she just marries a crook and he gets her to change and quitclaim the deed? Yeah, it's hers. She can do whatever she wants. My wife and I need to agree, in writing, in a document that says what happens to our assets when we're alive, when we're sick, and when we're dead. Because no way are my kids going to be disinherited. It's not going to happen by accident. It's not going to happen by design. Now, my wife can go and create millions and millions of dollars and marry whoever or whenever, and whatever they build, they can do whatever they want with. But not what we built or what we built grows to is going to anybody else except our children. Like I said, write a bestseller. Title your assets properly and make sure that you put those provisions in. Simple baby steps, and you lick this. A lot of people are worried about probate, as they should be. Probate is long, it's time-consuming, it's expensive. There are attorneys that will tell you that the money in your pocket would qualify you for probate. I'd probably ask your attorney, a little bit more specifically, what does that mean? But usually, if you own a house, it's something that you could qualify for probate. Joint tenancy has faked a lot of us out, because if a first spouse passes on, you don't have an immediate probate. But then, that survivor passes on. Now you have a problem. And I'm going to bring out another problem. And this is a very, very, very important problem. If your parents ask you to do this, or you ask your children to do this, I want you to stop and rethink this. I understand the intentions. As my grandmother said, the road to hell is paved with good intentions. Don't place your children's names on your accounts. Don't put their names on your deed. Don't put your parents' names. Don't put your kids' names. Don't do it. Now you're opening a can of worms with their creditors. You're opening a can of worms. What if they get divorced? What if they're in an accident? What if they get sick? Be very, very careful and well advised before you put your children's names on your assets. Conservatorship happens, it's like a living probate. It happens when we get sick and no one has access to your IRA. That's where you need the get out of jail free card. We've talked a lot about unwanted beneficiaries. You can see it's a hot subject of mine. My plan's different than each one of yours. Each one of you has a different plan. Now, you know the fastest age group for second marriages is 40 plus and 50 plus and 60 plus. You realize what happens when two different families collide. Usually the kids don't get along, and they're going to fight about money. And I'm just trying to be practical with you. Have a plan for it well ahead of time. Couple and I were talking. This is an absolute true story, and it happens all the time. They bought a house together. They both put in their money, and they agreed this was a second marriage, that when one spouse passed on, the other spouse can live in it. When the survivor went, it would go 50-50 to each one of their respected families. They said that, but where was that in writing? Even if it was in the will, does it matter? Why should it? I mean, it said joint tenant with right of survivor on the real estate deed. Doesn't that supersede what other documents might say? Now you got a will contest, you got problems, you have issues. You could have created something simple like a life estate and avoided all that problems. 6 essential documents. I talked about them here. I talked about roundabout ways, powers of attorney, guardian forms. I talked a little bit about trusts. Find out what's right for you. Go speak to your attorney. Go speak to your advisor and find out what's right for you. But regardless, I recommend you have 2 forms that don't cost anything. One is a document locator. List all your assets. List who it needs to be called, where they're located, whose name's on the safe deposit box. You realize millions upon millions of dollars goes to the state in every year because of unclaimed bank accounts, because people didn't know where assets were. Safe deposit box that were never opened because no one knew about it. Have a document locator. It's so easy to fill out. You can do it in an afternoon. It might even be a nice gesture and a good exercise. You don't have to tell everybody what's in it, just where it's located. And you do need to appoint someone other than your spouse on your safe deposit box. And I do recommend that you get a safe deposit box. Negotiate with a bank. I'm sure they're going to love this. But tell them if you're going to keep a deposit there, they have to give you a free safe deposit box. They're making enough money off of us as it is. Get the free safe deposit box. Recently, I saw a riddle. It said a guy sat down and he wanted to open up a CD. And the banker said, sure, you have to pay me 2.5% and I'll open up that CD for you. That's how it's getting lately. It's all about baby steps. Let's admit and let's realize and let's come out of the closet and say, okay, we need documents. We have to go and look at our deed. And if it's titled incorrectly, fix it. It may be as easy as walking to the stationery store and just retitling it. Get some advice and figure out what's the best way for you. You may have heard of trust. You may have heard of separate property. I don't know what's right for you. I know it's easy to fix with your plan. Have the right documents. Make sure you know who your beneficiaries are. Make sure you know the first and the second beneficiary. It is important. It's your money. And as I've talked about, you have an IRA and you make your spouse the beneficiary, or you make your daughter the beneficiary. Look, I don't want a son-in-law inheriting my assets. I just don't. You may, so fine, put his name on it. I don't want that to be. And if I give my daughter the beneficiary rights to my IRA outright, she's going to commingle it with the family assets, and now it becomes part his too. It can get all mixed up. There's a divorce, it probably will get mixed up. I'm not going to let that happen. I'm going to have provisions. I'm going to have a plan. If I die and there's money left, and my daughter were to inherit it, and she's having creditor problems, I don't want them to get the money that I was going to inherit to her. I want a plan. It's easy. It's baby steps. It's small bites. One step, one document at a time. There's 6 that we need to go through. The titling document, the beneficiary document, and then you just go right through the list. It's easy. It's easy. You can protect your assets. You've built them, you've maximized them, you protect them. Create the life plan. You know why many of these CEOs are just so out of whack when it comes to what's going on in their corporations? And there's going to be more and more. It's always going to happen. It's a good cycle, actually, that we're getting rid of it. It's because they stopped going to their monthly budget meetings. They stopped going to their monthly finance meetings. Don't stop yours. If you go to this monthly meeting that you create with a set agenda, it's easy. Follow the system. You can't one day be a momentum investor that's buying tech stocks, and then the next day you're buying dividend-producing utilities. You have to have a system and a plan. Chances are you're chasing something that already happened. Think about rear-view mirror investing as opposed to looking at tomorrow's headline. Create your dream team, stick with it, unless 2 things. It's over 10%, or you have the cockroach problem. You have the cockroach problem, move on. Every day is a good day to invest. I'm not saying you need to buy and hold like you do your home. Every day. There's 10 sectors of the S&P 500. In every bear market, some of those are up and some of those are down. You need to rotate and be in those sectors that are up before they're up. That's what makes a successful investor. And then have the paper that protects. You know what's right for your family, go get the document. If you have a great advisor, they want to charge you a lot of money, money well spent. You find another person, another attorney, another advisor that you like, all I'm saying is cost is important, but this is your life. This is your money. This is your beneficiaries. This is protecting you if you get sick. This is something that this is of the utmost importance in terms of your homework assignment. Do it now. Don't let it overwhelm your life. Don't let it become you. Wealth will happen. You'll protect it. You'll keep it. You'll maximize it. Take care of your family. Take care of your assets once a month. If you want to make sure that you do it, follow my rules for a happy and rewarding marriage. Never both be angry at once. Yield to the wishes of the other as an exercise in self-discipline if you can't think of a better reason. If you feel like you must criticize, do so lovingly. It's a tough one, isn't it? Never bring up a mistake of the past. That's my hardest. Never let the day end without saying at least one complimentary thing to your life's partner. Never meet without an affectionate welcome. Never go to bed mad. Remember, it takes two to make an argument. The one who is wrong and the one who is doing all the talking. Protect your money, protect your family, build wealth. Thank you for coming to the Life Plan presentation in the clinic on how to accumulate, maximize, and protect your life savings.